So what's the best way to approach this market at a time when news flow from center has dried up and none of the numbers have been above estimates? Let's discuss that and let's debate that with Prateek Agarwal, Chief Investment Officer with ASK Investment Managers. Prateek, morning. Good to have you back on ET now. Prateek, let's start with numbers. 4 index companies which have come out with numbers so far, excepting HCL Technologies, the other 3 have disappointed at a time when the expectations were low.
Yeah, that's fair. It's not exactly a huge disappointment. I think the numbers were mixed. There has been a decent amount of PAT momentum versus expectations. They were okay. So till date, I think we would be satisfied with numbers rather than saying that we would be disappointed with numbers.
Prateek, in particular, let's chat about HCL Technologies. After what we've seen from Infy and now HCL Tech, do you think the stance increasingly is shifting towards names like HCL Tech and TCS and money is moving out of Infy?
We would not agree to that. Frankly, if you look at the IT space, you will see that companies which have acquired businesses in the past or have taken over, let's say, infrastructure kind of businesses, which involves taking over the team as well as infrastructure assets. You know, what happens in those kind of businesses is that in the year that the takeover happens, the margins are extremely low. And afterwards, you know, as people get shifted into India, costs get rationalized, the margins start to improve. So we have seen that trend in the last quarter. It probably continues in this quarter, that companies which went for more longer term contracts, either you know, bidding out long term contracts where again you have you know, first year where the profitability is not very high and then it gradually ramps up, or infrastructure contracts or actual acquisitions of companies, there the sustainability of numbers have been seen to be of a higher order versus companies which were focused on margins which were derived from shorter term contracts. Shorter term contracts, clearly the space has been soft because of the softness in the economic environment in the West. So that is what is happening. You know, if you look at the kind of ROCE or an ROE that a business delivers, one can make out the difference. Typically what happens in a quarterly number is that one looks at the number and the margin for that quarter, forgetting what has been paid in the past. We have to look at both and then find out how good the business actually is. So, you know, while yes, these companies which have acquired businesses in the past will deliver strong quarterly numbers, but they may never command the valuation that companies which have grown organically would. At this point in time, we believe something like an Infosys has set for itself a bar which is just too low. The quarterly numbers were good. We were pretty satisfied.
So from your perspective, Prateek, I don't want to get this one wrong. Are you indicating that it's time to buy Infosys and not time to buy TCS or HCL Tech?
Now look at what is the implied growth in various stocks and what has been delivered in the past, and one would get the answer to that effect if Infosys gets back to the growth path that it had set for itself in the past. Clearly, we believe it may be cheap at this point in time versus some other large cap businesses in the IT space.
Prateek, for investors who have missed this year's rally, should they use the current decline stroke consolidation to their advantage and should they start buying?
No, frankly, if one goes by the momentum of policy making, our sense is that a lot of what may happen in future may not be good for stock markets. So for example, if the company bill gets passed, there is a provision there of 2.5% of the profit to be spent on CSR. So, you know, that is de facto a tax increase. Would markets respond positively to it? I have my doubts. Maybe negatively, yes. If suppose they start to do coal auction, then the cash balances with some of the coal companies may reduce very significantly. So a lot of what is being proposed going forward, including large amounts of government disinvestments, depending on the sentiment in the market at that point in time, may be positive or negative, but a lot of the other proposals may be actually negative. So one needs to be extremely cautious. If the leg of this rally was account of QE money coming in and reforms, well, QE money could dry out in a few days, any which ways the holiday season is approaching, and the momentum of government reforms, I mean, frankly, if it continues same way, the next few reforms may not be positive for the stock market. So I would suggest caution at these levels. Get into stocks where the dependence on reforms, on policy making is low and visibility of earnings is high. I think that's the part of the market which can again start to find flavor going forward.
Prateek, what is your sense on what we may see from ACC and Ambuja today? And more importantly, the news yesterday wherein ET now learned that perhaps they may have to pay 2% higher royalty to Holcim, and that didn't quite augur well for the stock moves yesterday.
No, so fair enough. I think the cement numbers as such should be good. That's the expectation. One company has delivered numbers, they were good. Others should do it the same way, because this year any which ways monsoons got postponed. The volume growth numbers are better than what they otherwise would be. Going forward, again, the outlook for cement is good because the capacity utilization levels are seen to be improving going forward. Yes, company specific issues remain. If something like a cement can pay royalty, then frankly we do not know what is it that may not pay royalty. There is hardly any IPR that goes into manufacturing of cement, especially in a country like India. So I think there will be opposition to that, even in businesses wherein actually there is some transfer of technology. Investors do not like royalty kind of movements. So very clearly this is not an investor friendly move at all. The owners need to make their money through dividends, through the fact the holding in the stock moves up, the prices of the stock move up, rather than taxing the business on the lines that the government does by taking out royalties.
Prateek, market insiders are also telling me that you're extremely hot on agri as a theme. Now, the world's been bullish on agri as a theme, but none of the agri stocks or none of the agri companies are going. Just a handful of them I can think of, and those handful companies have plenty of headwinds.
No, so extremely hot is the wrong word to use, but yes, we have some exposure to the agri theme. See, frankly, if you look at the market, we are more positive on the consumption theme, and our sense is that consumption oriented towards rural India will probably tend to do better than consumption oriented towards urban areas. So yes, we have some exposure to FMCG, we have some exposure to agri businesses, seed companies, and multinational crop protection companies. Our sense is if economy strengthens, rupee strengthens as a consequence of that, then a lot of these businesses which are import dependent may actually see margins improve going forward. So we have some good names there, high quality businesses where valuations are not stretched. We believe they may just deliver good value to our investors.
What is your understanding of the currency market, and in the near term, directionally, are you betting on commodity rupee, rupee exporters or rupee importers?
No, no. Our current account deficit numbers are not getting into control. They continue to be over at least my comfort levels. So clearly the strength in the rupee is a function of the kind of flows we are looking at. If for reasons like people going on leave. I mean, ultimately Christmas is around the corner. The flows taper off for a period of time. I suspect that rupee may just start to weaken a bit from where it is today. But ultimately, if you are a medium to a long-term investor, one has to remember that of the larger emerging economies, India is probably the only one which is current account deficit. We became current account surplus sometimes in 2002, 2003. We can again become current account surplus country. The odds are pretty high. So over a period of time, longer term currencies would strengthen, but in the near term, it's a difficult call. When we buy businesses, we assume the currency level to sustain rather than a violent movement on either side, and actually look at the underlying business where the business would be able to sustain currency movement and yet be able to deliver some upsides.
Prateek, having said that, do you think the beta trade or the rotation trade in this market is not holding on because banks, real estate, capital goods stocks, they've cracked, and they've cracked quite substantially from the recent highs? None of the asset owners are anywhere close to their recent, anywhere close to a 52-week high. And if I look at FMCG and pharma, that's where all the action and strength is.
Yeah, so that is what I responded in the first question asked to me, that going forward, beta may not perform, because what is beta is heavy on assets. So yes, there may be an interest rate cut going forward that will help asset owners, but apart from that, there is hardly much that they can really look at. I think policy making going forward would not favor this part of the market. So I would not be too enthused to chase beta at this point in time in the market. The FIIs may take a holiday. The effect of QE ought to be tapering off if you go by the past experience any time now. And like I said before, reforms going forward may not all be positive for the markets, except for expectations on lowering interest rates. There is hardly anything that is unequivocally positive for the equity markets. One needs to focus on that. It's better to buy businesses which are cheap. Reforms are happening in that space rather than generally chasing beta. Beta may cut on the other side going forward.